Hello and welcome back to What Changes. I'm May. Today we are looking at a financial conflict that is unfolding in real time. It is a conflict that involves billions of dollars, the highest levels of the United States government, and the fundamental pricing mechanisms of the global economy. We are witnessing a collision between the paper markets and the physical reality of supply and demand. At the center of this storm is a single, massive bet. A wager so large that it has the potential to break markets or bankrupt a billionaire. We are talking about a $300 million bet against silver. But this isn't just about one trader. It is about the reaction from the Trump administration, a gathering of 54 nations, and a series of market signals that suggest we are on the verge of a historic shift. In this video, we are going to break down the structure of this conflict. We are going to look at the whale, who is betting against the metal. We are going to analyze the silver weapons that the US government has just fired in response. We are going to examine the terrifying signals coming from the physical dealers and the exchanges. And we are going to ask the ultimate question: who wins? The paper short or the physical reality? Let's dive in. To understand this story, we first have to understand the antagonist. The market is currently fixated on a figure who has emerged from the shadows of the Chinese trading world. His name is Bianing, sometimes referred to as a low-profile Chinese trader, but his actions are anything but quiet. This is a man who has already proven his ability to navigate the precious metals markets with lethal precision. According to the reports we have, this trader previously made nearly $3 billion from bullish trades on gold. He is not a novice, he is a whale. And now, he has turned his sights on silver. But this time, he is not betting on the price going up. He is betting everything that the price will go down. Bianing has placed the largest net short bet on silver in the Shanghai Futures Exchange. The scale of this position is staggering. We are looking at a position worth approximately $300 million. In terms of physical weight, his short position totals roughly 450 tons of silver. To put that in contract terms, that is 30,000 contracts. This is a massive vote of confidence in a market crash. And initially, it seemed like the right move. Silver recently experienced a 16% drop, which significantly boosted the paper gains on his position. If you look at the chart, the timing seemed perfect. But there is a problem. While this Chinese billionaire was establishing this massive short position, the geopolitical landscape shifted underneath him. He is betting against silver at the exact moment that the United States government decided that silver and other critical minerals are matters of national security. He is shorting the market right as the Trump administration decided to fight back. While Bianing was building his 450-ton short position, a very different kind of meeting was taking place. The Trump administration, led by JD Vance and Marco Rubio, convened a ministerial meeting involving 54 countries. This wasn't just a photo opportunity. This wasn't just a standard trade summit. The topic of this meeting was critical mineral supply chains and pricing mechanisms. Now, when politicians use the phrase critical minerals, you need to understand what they are actually saying. In this context, critical minerals is code for physical silver. The message coming out of this meeting is unambiguous. President Trump is not going to allow China to corner the silver market. The administration understands that there is a global structural supply deficit in silver. They know that we are running out of accessible metal, and they have identified the only 3 ways this deficit can be fixed. According to the source, the deficit can only be alleviated through 3 specific mechanisms: higher prices, increased production, or decreased demand by cutting off Chinese access to Western metals. The Trump administration has essentially just fired all 3 of these silver weapons at China simultaneously. Let's listen closely to what JD Vance said at this meeting. He emphasized that despite all the focus we hear about the digital economy and the tech economy, real physical commodities remain fundamental to the world. He noted that the people in that room, representing 54 nations, accounted for roughly 2/3 of the global GDP. He stressed the need for greater independence. He stressed the need for self-reliance. But most importantly, he addressed the condition of the market itself. JD Vance stated that international critical minerals markets are failing. They are failing to create sustainable domestic industries. They are failing to secure supply chains. He pointed to persistently suppressed commodity prices, which are influenced by forces outside of individual nations' control. This is a polite way of saying the price is being manipulated. He acknowledged that mining projects frequently stall and fail because the pricing is so erratic and unpredictable that consistent investment becomes nearly impossible. The stated goal of this meeting is to stabilize pricing to enable domestic supply chain development, but the implication is much deeper. The US government is now officially recognizing that artificial price suppression in critical minerals markets is real. They are admitting that the current pricing mechanisms are dysfunctional, and they are stating, on the record, that they are working to address it through policy. This represents an official acknowledgement at the highest levels of government. They are saying that the market is broken and requires intervention to support strategic domestic production. They are effectively trying to establish a price floor system to restructure the entire global critical minerals market. So, on one side, you have a Chinese billionaire betting $300 million that silver will crash. On the other side, you have the US government and 54 nations coordinating to ensure that prices stabilize and rise to support production. This is the definition of an unstoppable force meeting an immovable object. If we step away from the politics and look at the physical market, the situation becomes even more alarming. The source describes a physical reality that is completely divorced from the paper price. Let's look at Australia. There is a bullion dealer there called City Gold. They recently had to halt silver sales. They didn't stop selling because they wanted to close up shop. They didn't stop selling because there was no demand. They paused retail sales because of a global silver shortage. It is important to clarify this point. This was not a temporary spike in demand that cleared out their inventory for a day. This was an actual shortage of metal, forcing dealers to stop selling. The metal simply isn't there. Now let's look at India. The MCX exchange in India recently hiked silver margins by 7% and gold margins by 3%. You have to ask yourself, why do exchanges raise margins? They don't do it when they are comfortable. They don't do it when the market is functioning normally. They do it out of fear. High margins equals stress. Stress equals positioning risk. And positioning risk means there are too many traders on the wrong side of the trade. The exchange is not raising margins to protect you, the investor. They are raising margins to protect the system itself. The market is telling you what it fears. And notice the difference. Gold margins were raised by 3%, but silver margins were raised by 7%. Silver is the pressure point. Silver is where the panic lies. We can see this panic in the backwardation. This is a technical term, but it is crucial to understand. Silver has been trading nearly 80 cents per ounce in backwardation after the recent price slam. Backwardation means that the spot price, the price you pay for metal right now, is higher than the futures price, the price you pay for metal 3 months from now. Specifically, spot silver is trading approximately 80 cents above the front-month March futures. This is a historic anomaly. In a normal market, futures are more expensive because you have to pay for storage and insurance. When the spot price is higher, it means there is a massive shortage of physical silver in the market right now. It means nobody wants to wait. It means the market is desperately tight. So we have dealers halting sales. We have exchanges hiking margins out of fear. We have backwardation signaling a desperate shortage. And yet, the paper price has been slamming down. This is the classic divergence that defines these markets right before a reset. The contrast between collapsing paper prices and intensifying physical scarcity is the signal. This silver war isn't happening in a vacuum. It is happening against the backdrop of what the source calls a coordinated worldwide reset. Everything is crashing simultaneously. Let's look at the crypto market. On October 6th, the crypto market hit a record high market cap of $4.3 trillion. Today, at the time of this report, crypto is worth just $2.3 trillion. That is a loss of $2 trillion in market cap in just 4 months. 46% of crypto's entire value has been wiped out since October. Bitcoin has dropped below its 2021 all-time high. The stock market is also trembling. US stocks are falling after weak job data. The Nasdaq is down 1.34%, wiping out $517 billion. The S&P is down 1.13%, wiping out $695 billion. The labor data is terrible. Initial jobless claims rose to 231,000 versus the 212,000 that was expected. Layoffs are increasing. January job cuts were the highest since 2009. Companies are announcing very few new hiring plans. When layoffs rise and hiring slows together, that is a leading indicator of severe economic weakness. And then there is the US dollar. The dollar is dumping at the fastest pace since 1980. It is currently the second worst performing currency across all G10 countries. Just 1 year ago, it was the strongest. Now, currencies like the Australian dollar are up 8%, and the Swedish krona is up over 10% against the dollar. Why is the dollar failing? Rising political uncertainty, aggressive and unpredictable trade policies. The market is pricing in the risk of a broader trade war. We are seeing a sell America trade, where global investors are reducing their US exposure. Capital is flowing out. There is growing concern around Fed independence and the US fiscal deficit. Government debt continues to increase, and large-scale spending raises questions about long-term stability. And amidst all of this, we see China making a strategic pivot. China is dumping US treasuries. Their holdings have dropped to $682.6 billion, the lowest in 18 years. They have reduced their treasury position by over $600 billion since the 2013 peak. Where is that money going? It is going into gold. China's gold reserves have reached an all-time highs at 74.1 million ounces. They have doubled their gold reserves while dumping their dollar assets. The shift from dollar-denominated assets into physical commodities is measurable and ongoing. There are even rumors, acknowledged by Treasury Secretary Bessent, that China is developing digital assets backed by physical commodities for international payments. Now let's get technical for a moment. I know some of you want the details on the price action. Current prices, as recorded in the source, show Western spot silver at $70, Shanghai spot at $81, and Shanghai futures at $99. The premium in Shanghai is $11. Gold is trading at $4,808. We saw a technical rejection at the 87 to 90 zone on the paper market, a resistance level that was called out previously. The price pulled back to around 71. For long-term investors and physical stackers, this volatility is described as pure noise. But for traders, especially those using leverage, this is a dangerous environment. That if you are over-leveraged, sizing too big, or trading without a plan, these markets will eat you alive. You need a solid strategy and ironclad risk management. We also need to look at the COMEX delivery reports. We are seeing massive delivery notices. For silver, another 608 delivery notices were issued on a Wednesday. JP Morgan issued 531 of them and stopped 239. Total COMEX February silver deliveries have risen to 3,563 contracts. That represents 17.815 million ounces of silver delivered just 4 days into a non-primary delivery month. For gold, the numbers are also significant. Total February gold notices have risen to 32,004 contracts, representing 3.2 million ounces. Physical demand is described as relentless. This brings us back to the theory of the coordinated smash, that the derivatives crash in silver, the drop that helped the Chinese billionaire's short position, was timed right before the critical 54-country meeting. It wasn't random, it was a coordinated smash, designed to set the table for the new policy interventions. So, here is the situation. We have a Chinese billionaire, Bianing, holding a 30,000 contract short position, betting $300 million that silver will fall. We have the Trump administration and 54 nations implementing a price floor system and restructuring the global market to end manipulation and cut off Chinese access. We have physical dealers halting sales because they have run out of metal. We have backwardation hitting 80 cents, proving a desperate physical shortage. We have the crypto market crashing 46%, the dollar dumping, and China swapping treasuries for gold. The tension is unresolved. Does Bianing's $300 million short get squeezed as the Trump price floor is implemented and the physical shortage intensifies? Or does the deleveraging continue, pushing prices lower before the structural forces take over? The exchanges are raising margins. Forced selling is possible. But JD Vance has stated that manipulation must end. Price floors are coming. Who wins? The Chinese billionaire with his paper short? Or the administration's physical restructuring backed by a global shortage? The timeline will determine if we test lower prices or if this is the bottom before policy changes everything. But one thing is certain. The precious metals market is in the midst of a fight between banksters, who are still shorting the metal, and overwhelming global physical demand. We are witnessing a coordinated worldwide reset in critical minerals, from discovery to market to production. Do your due diligence, understand the risks. Sentiment has reached extremes, leverage is unwinding, and the whales are taking their positions. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. I'm May, and this is what changes. Stay tuned as we continue to watch this war unfold.